Hello dear students, I am Shobha BZ, Associate Professor, School of Management. So in this video lecture, we are going to study one of the very important techniques of financial statement analysis, which we call it as a ratio analysis. So ratio analysis is called as one of the scientific tool for the financial statement analysis because this analysis is going to give us more meaningful insights into the financial performance of an organization. So in today's class, we are going to discuss or to understand what is the meaning of ratio, definition of ratio, and also one classification of ratios among the different classification, which is called as a liquidity ratio. Let us begin our discussion by knowing the meaning of a ratio. So ratio is nothing but it is a mathematical expression of the numbers. So in ratio, we are going to compare one figure with the other relevant figure or with the figures. So in ratio, we are going to compare one number with another number or one item of our financial statement with another item of our financial statement. For example, we always compare our gross profit with the sales, right? What is the percentage of profit that we earn on the sales? So under ratio, we are going to compare one number or the one figure with the other figures which are found in the financial statements. So ratio analysis is one of the technique of financial analysis to evaluate the financial condition and also the efficiency in the performance of a business concern. So let us look at one definition which is given by the Mayers. So he defines ratio analysis of a financial statement is a study of a relationship among the various financial factors in a business as disclosed by the single set of statements and a study of trend of these factors as shown in series of statements. So according to this definition, ratio analysis is going to disclose what is the relationship between the various financial factors. Just now I took an example how gross profit is having a relationship between with the sales. Right? What is the percentage of GP that we earn with the sales, or what is the expenditure that we incur to produce a product to produce it, and its relationship with the gross profit. Or just take like current assets or current liability. So compare current assets with current liability. We can build up a meaningful relationship. What is the quantum of assets that an organization has when we compare with the quantum of liabilities? So comparing our current assets with the current liability can tell us is how strong is our current liquidity position, right? So how well we manage our day-to-day operations. So ratio analysis, we are going to compare or find out what is the relationship. Is it a positive or is it a negative, right? So these relationships are going to be built by using the financial statements, and we are going to find a trend of these relationship by taking into consideration the financial statements. Depending on the purpose, the person who is going to use these ratios, we have a different classifications of ratios. For example, if I'm an investor, so I may be looking into the profitability of an organization. So my interest is to know what is the profit that the organization is making and how much is profit given to the end users. Or if I am the part of the management team, or assume I am the production manager, so I may be interested in knowing the turnover ratios, where we have the ratios called as a turnover ratios, which tells us how fast our raw material is converted into the finished products. Like this, we have a different types of ratios depending on the purpose or the people who are going to use the ratios. We are going to choose them. So let us begin our discussion with the different classifications of ratio. So the first classification is liquidity ratio. So these ratios are going to test the liquidity position of an organization, means how efficient is the organization in meeting its day-to-day obligations or to meet its short-term obligations. So in liquidity ratios, we have two classifications. One is a current ratio, another is a liquid ratio or acid test ratio. So the current ratio is going to measure our working capital position or our ability to pay for its current liabilities. So the formula what we use to calculate the current ratio is going to be current ratio is equal to current assets divided by current liabilities. So when we calculate the current ratio, we take into consideration all the current assets and current liabilities into consideration. So that will tell us what is our working capital position or how efficiently day-to-day operations are conducted without disturbing to its operations. So when you look at the benchmark or the standard which is set for the current ratio is between 1.5 is to 2. So for example, if organization financial statement, if we take it up, if we calculate, if the ratio comes as 2, it means it's a 2 is to 1. We say that current financial position is very good, liquidity position is very good because the current assets are double than the current liabilities. Right? So some of the organization where there may not be requirement of too much of current assets, even if it is 1.5 is taken as a satisfactory ratio or uh, above the average ratio. In testing the liquidity position of an organization, we have another category which we call it as a quick ratio, or we can call it as acid test ratio. So this acid test ratio is going to assess the company's ability to meet the short-term obligations without relying on the sale of an inventory. So the formula for to find out the liquidity or the quick ratio is current assets minus inventory divided by current liabilities. So we calculate the asset test ratio by taking into consideration the liquid assets divided by current liabilities. So here the liquid assets are nothing but the current assets where we will be excluding the inventory and the prepaid expenses. Why do we exclude inventory? Because with the notion that this inventory cannot be converted into cash as fast as like other current assets. And many times, if we are going to sell our raw material in case of emergencies, we may not get the price what we are paid for it. And again, one more asset we are going to exclude while calculating a quick ratio is going to be prepaid expenses. So here prepaid expenses are already paid in advance. So there is we are not going to get any money out of it. It's only an asset because that some expenses which have been paid in advance. So here the standard benchmark usually for this asset test ratio is going to be 1, or if it is above like 1.2 or 1.3 is also considered as a standard ratio. So if when we calculate the acid test ratio or quick ratio, if it is coming around 1, close to 1, it means acid test ratio is going to be 1 is to 1, means our liquid assets are equal to our liquid liabilities. So we say that is organization's liquidity position is good and it is satisfactory. Then another ratio which we can use in testing the short-term financial obligations is going to be the cash ratio. So cash ratio measures a company's ability to cover the short-term liabilities. So here we are going to use cash and cash equivalents divided by current liabilities. So this, if cash ratio comes around 0.5 to 1, we say that it's good and it is acceptable. With this, I'm going to conclude my discussion. So let us recap. In this video lecture, we discussed one of the important tool of financial statement analysis, which we call it as a ratio analysis. So ratio analysis is considered one of the scientific tool of financial statement analysis. In the ratio analysis, we are going to compare or find out the relationship between the different items which are found in the financial statement of an organization. So these ratios are going to help us to find out what is the present financial position, and also we can identify what is the trend of these ratios, in which direction they are going to move. So there are different classifications of ratios, but we have discussed only one categories of ratios, which we call it as a liquidity ratios. So liquidity ratios are going to tell us the liquidity position, which we call it as a current financial position or short-term financial position of an organization. So when we are going to test the short-term financial position, we use three ratios, which we call it as a current ratio. Then second is the asset test ratio, and third is a cash ratio. So if you talk about current ratio, we take the current assets and current liabilities into consideration. So the ratio between 1.5 to 2 is considered as a standard, or we can take it as a benchmark to decide how well or how good is the current position. If it is below 1.5 or above 2, we say that yes, working capital position is not good and current assets and liabilities are not managed properly. Then the second classification that we discussed is asset test ratio, which tells immediate requirements, how the organization sources funds for the immediate requirement, where we use the asset test ratio. So in asset test ratio, we are going to consider the liquid asset. We take the liquid asset. So liquid assets are nothing but the current assets, where we exclude the inventory and prepaid expenses. So for the asset test ratio, we take the benchmark of 1. If the ratio calculated is less than 1, or if it is more than 1, both are not the ideal situation. If it is less than 1, means there is a shortage of liquid assets. If it is more than 1, we say that there is a idle liquid assets which may not be properly utilized or which may not be required. Then the third category that we discussed is the cash ratio, where the benchmark is 0.5. So with this, we are going to conclude our discussion. Hope the lecture is going to add some value to your knowledge. Thank you. Thank you so much.